Good afternoon, ladies and gentlemen. It is December 2nd, 2021, and this is Robert Rayburn here at Life Pro Asset Management. And we certainly hope that everyone had a great, happy, and safe Thanksgiving holiday. We know that it was interrupted by some market volatility there on Friday. And then certainly we've had some continued volatility as we've progressed into the week after Thanksgiving. So what we're going to do this week is kind of go through what this Omicron variant really means for the market, how virulent is it, and in particular, is the sell-off really related to the variant, or is it simply an excuse to take some money off the table after what has been a very strong 2-month rally in the stock market? In other words, stock market got pretty overbought. Sometimes it's okay for markets to go down for a few days, let off some steam before resuming that uptrend. So what I'm going to do is go ahead and share my screen here. And what we're calling this week's update is panic or buy. And the reason why we're calling it that is every few months we get some sort of excuse for the market to panic. That's never going to go away. For as long as the stock market exists, for as long as human beings exist, as a species, we have a tendency to panic over very short-term events. That will never change. What we can do to help ourselves, help our families invest, is to really take a step back each time there is a panic and say, is there substance behind the panic? And if there is substance or no substance, what are the steps afterward that we need to take in order to properly position portfolios for the future, not for what happened yesterday? Now, this week, we're going to go through 3 key objectives. One is, how do we navigate the market when we do get these media hit jobs as it relates to fear? Number 2, how much risk is actually priced into the market? Versus the actual risk that our businesses that we're invested in as investors face. And then lastly, has inflation peaked? We know inflation's all over the media. People are scared, rightfully so. 6% erodes our cash value. Has it peaked? And if it has peaked, what does that mean for how we should be positioning portfolios going into 2022? Now, we call this the fog of war. We were all eating turkey last Thursday, and we come into Friday morning, and sure enough, the markets are getting whaled by this Omicron news. And if we look at the actual news headlines as it relates to Omicron versus Delta, and by the way, all the evidence so far is that Delta is much more virulent than Omicron is. It's quite impressive when you think of the number of headlines that have inundated the global media. So we see here the blue line. This is where Delta headlines peaked out. This was in around the July and August time period. And then, of course, Omicron. And it just absolutely dwarfs the amount of headlines we ever had to put up with on Delta. And the doctor that actually discovered the variant called Omicron has said, I've seen nothing in this variant that warrants Britain's extreme response. We agree. When we look across all the cases so far, they've almost in uniform been extremely mild. Mild fatigue, some runny noses. So far, this particular variant does not appear to be anywhere close to the virulence that Delta or prior strains have had. Now, could that change? Of course, absolutely. Facts can sometimes evolve, but so far, based on what we've read, based on what we've seen out there from actual experience, is that the market might very well be using this as an excuse to take some money off the table over the very short term. And why do we think that? Well, if this was really about COVID, if this was about the fear of shutdowns, what should work? Well, Zoom should work, or Peloton, or Teladoc, or DraftKings. These companies that do well when people are sequestered at home. These businesses tend to thrive during times of shutdown. And what we saw was an initial spike in many of these stocks on Friday before making new lows this week. That is why we're somewhat skeptical that the market weakness really is a result of COVID. We actually think that this is more a result of a market that was just very overbought. We talked about this 2 weeks ago ahead of Thanksgiving. We were somewhat concerned that going into Thanksgiving, we're facing a liquidity vacuum. In other words, no one's around. They're all at home eating turkey, and we get one of these headlines. Now, we're not going to actually trade based on that, right? But it was something that we need to be aware of. If it does happen, let's ignore it. Let's proceed in terms of our multi-year plan as it relates to our investments, and don't take too much interest in it. So far, that's exactly what's happened. Now, on Twitter, we put out a major buy alert this morning, right? So what we said to investors, we watch the volatility market. Volatility is a great way to see how much risk is actually being priced into the market versus the risk that we actually face. And what we see here is that the implied volatility spread, so in other words, the spread of premium of put options versus call options, puts go up when prices come down, so that demand for protection has hit a record level that we haven't seen since March of 2020. And if we remember, what happened in March of 2020? A major bottom. So we actually think, based on what's taking place in the volatility market today and over the last week, that today represents a very attractive buy signal. Now, could we be wrong? Of course we could be wrong, right? But based on our signaling, what we look at, this is a major buy alert. The other thing that we're looking at too is that this chart here on the left is that over the last 2 days, we've had 2 days, not the last 2 days, but we've had 2 days where we've had 90% down days. When we get successive 90% down days in a strong uptrend, that tends to be a buyable dip. When we combine the chart on the left with the volatility spread on the right, we think this is a very attractive buy moment. And of course, then we have to ask ourselves, when we do get these buy moments, what do we buy? Well, we want to buy structural strength. In other words, don't buy stocks that were making 52-week lows prior to the sell-off. Buy stocks that were acting well prior to the sell-off. So when we look at energy, 90.5% of stocks were trading above that 50-day moving average. Yes, we've now had, that they've been in a structural uptrend. Now, over the last week, those energy stocks got hit. Now, only about 15% of them are trading above the 50-day moving average. That's what we call a buyable dip moment in an area of structural strength, versus what we see in staples or utilities, where prior to this, only 37 or 40% of stocks were in a structural uptrend. Don't buy structural weakness, buy structural strength, because the market, as panic subsides, tends to go right back to those areas of long-term strength. And that's what we're trying to do. Secondly, we look at this chart here on the left, and I apologize, we're kind of going backwards as we flip through these slides. But what we see here is that the forward returns for the S&P 500 tend to be quite attractive after we get a sell-off in the market, or in other words, when 20-day lows are greater than 50%, but we're in a structural uptrend for the market as a whole. So when 20-day lows peak above 50%, the 125-day forward return, historically speaking, has been 10.9% versus 4.4% for all other observations. Again, past performance is not indicative of future performance, but what I would say here is that history has strong analogs, and markets tend to repeat themselves. And economically speaking, things look really good. So if we look at jobless claims again hitting those cycle lows. Now, when we look at jobless claims, it's very important. It's a high frequency data point. Now, we are going to get the non-farm payroll number tomorrow, and certainly there's going to be a lot of volatility around that. But that week-to-week claim number is more important in our opinion. What we see here, again, we're at levels of where we were back in 2019. And then, of course, we look at the travel numbers. When we look at those TSA checkpoint volumes, they're back to where we were, close to where we were in 2019. And we compare it to 2019 and 2020, not only do we see a strong recovery versus last year, but we're now getting close to approaching 2019 levels. I think that says a lot about where we are in the reopen, but also that dislocation of where we are versus where a lot of these reopen stocks are currently trading. There is a valuation discount that we can benefit from if that valuation gap closes. And then as it relates to inflation, that prices paid number has started to roll over. So when we go across the supply chain, what we see is that when the consumer starts to suddenly buy a lot or go on a buyer's strike, it tends to magnify the impact on the suppliers. So when the government issued those payment checks and a lot of the assistance that a lot of people got across the United States, consumers started buying stuff like crazy, and that sent a shockwave through the system. And it literally looks like a shockwave. We see here the chart on the right. So if the consumer spends $2 more, it has almost like a 10 times impact on the supplier. Now, as consumer demand growth begins to normalize going into 2022, it's also going to have an outsized impact on suppliers in the reverse way in terms of improving those supply chain response times. And what we see here is those prices paid are starting to roll over, still at a very high level. As we said before, inflation, we expect to get less bad. We don't expect it to go back to 1 or 2%. We think in that 2, 3, maybe 4% range, but less bad. And that's what the market wants to see. We see the same here with dry bulk shipping rates, container freight rates. They're all starting to come down. We like to look at those tea leaves. And then we look at inflation expectations. Very, very important. Inflation expectations, because expectations ultimately is what drives price. And we see that the break-evens are starting to come down quite a bit. And with that, the market's expectation as to when the first Fed rate hike is going to be. Almost with certainty, almost 40% certainty, the markets thought that the Fed would hike rates in June. We now see that's come all the way back down to about 25%. So what's the bottom line message this week, ladies and gentlemen? It is that, yes, there are scary headlines out there, but how we manage that fear over the very short term is ultimately what separates winning from losing. We can make simple mistakes over the very short term and take part in that panic, and that can crush our long-term returns. But if we take a step back, let the markets breathe, and then make a decision over a 2, 3, and 4 week time period, that's really where we're going to make more informed decisions that actually add to return versus detract from return. So the 3 big takeaways: the new variant, yes, it has a scary new name, but the bark does appear worse than the bite. Symptoms are so far very mild. Number 2, evidence is piling up that inflation has peaked. And this feeds into point number 3, which is if inflation has indeed peaked, we actually could have an interesting barbell situation next year where energy, the banks, industrials, consumer work very, very well in that strengthening reopen trade, but also certain areas within technology that have gotten hit quite badly. And by the way, we're really happy that we sold a lot of those technology names over the last few months because now they're going to be available at very discounted prices. And because they have that valuation, a lot of their earnings are expected way out in the future. If rates start to ease back a little bit, those names could start to bottom. We're not saying they will, we're saying could. And we're going to start to look at some of those names here over the next few weeks. So that's what we got this week. If anyone has any questions, please reach out to your advisor, reach out to our offices. We're here to help. Our number is 888-543-3776. And again, have a fantastic weekend. And if you don't hear from us, or if you don't watch us again before Christmas or the holiday season, have a wonderful holiday season. Thank you again and have a great weekend.